Hi, I'm HJG White from eToro, and this is my 5 top picks for 2022. I want to make clear that these are my top picks, and this is not telling you to buy these stocks. This is just if I was to put 5 stocks in my portfolio and I was going to be locked in for the next 2 years, these are, I think, the 5 companies I would buy. So I'm, with interest rates going up in the UK, I'm looking for 5 recession-proof stocks, in my opinion. So I'm not looking for growth stocks right now. I'm looking for recession stocks with potential growth. And so let's get into this. Word of warning, every single stock that I'm about to mention is in my portfolio. Because I bought everything that I thought was good value, every position that I would pick is probably in my portfolio. So that's why I just want to give you some warning that I have major confirmation bias on my 5 top picks. But that being said, I don't think that I believe that I picked these on strong fundamentals. So let's get into the first one. My first pick is National Grid. Now, I have watched a few videos on how the National Grid structure works in the UK, and they predominantly, as I understand it, are responsible for the delivering of energy. So not generally speaking the creation of energy, more the delivery, but I do think they're getting involved with the production of energy as well. But they have really great profits, good free cash flow, and they've actually been growing enormously. They reinvest a ton of their cash, and because they deliver electricity and gas, they are incredibly future-proof over the next year, especially when it comes to pricing, and they are absolutely essential for every household in the UK. So they'll be raking in cash, they will move with the cost increases, they are protected against the different innovations because they deliver the energy. New suppliers of energy that are coming onto the grid, they aren't affected by the change from coal to solar because they make money when delivering the power that is generated. So yeah, they are incredibly well built for the times that we're in. And so the only issue with this one company, the only con that I can think of, is that they're slightly expensive. If they have a high price to earnings and not a whole lot of growth predicted in their future, then you could argue that they've got more room for the price to fall. But they produce, their shares produce 5% yield. So even if their price went down, you'd still be getting that 5% dividend over the next 2 years. So I think this is a really good stock to hold instead of cash. So I would rate this one as better than cash. Now my second pick is Tesco's. Tesco's is a UK-based supermarket in the UK 100, so their shares will be getting constantly rebought with passive income, but also they are growing. And what I also like, you'll notice a lot of the companies in this list made a really good profit in the pandemic, so they actually have a very healthy cash pile at the minute, which they used to buy back shares. So they bought back about 1 billion shares, or £1 billion worth of shares. I certainly know that they have just bought 250 million shares in the last quarter and are projected to buy back another 750 million shares. So they will be buying back another 1 billion shares, which will push up their earnings per share even higher without them receiving growth. So I do, in a recession, there's a pro and a con. It's people tend to spend money in the cheaper places. So instead of going to a restaurant, they'd go to Tesco's. However, if the prices of Tesco's are higher, there is a chance that they'd spend less at Tesco's also. So yes, Tesco's will raise the prices and they may get more customers on top of that. So if there is a recession, or just the fact that the cost of living is going up, Tesco's stand to potentially turn a higher profit this year. And then what they'll likely do is pass that profit on to their workforce. They'll have a high pressure amount to increase the living wages of their staff, which will in turn increase the profits of Tesco's. The people that work at Tesco's, they get a discount for shopping there, so it will come back to them again. So yeah, Tesco's I think is a really great purchase. They got a dividend also, so having it locked in even if the prices go down, because we're in such an unknown time, you know, earnings could absolutely be hit by Tesco's as well, and if they are, you can guarantee that the whole market will be feeling an earnings hit. So that would damage growth stocks more, but Tesco's should be resilient, especially as Tesco have a price to earnings of 13, but you can expect that to go higher next year. I mean, they just made so much cash in the last year. I'm quite surprised by it, but if that same cash level continues, then I mean, Tesco's are an incredible purchase. And so the only issue for Tesco's is that they are so spread out across the UK already that there's not a lot of room for them to grow, you could argue. But I think that they're doing some interesting things with the club card, they're doing interesting things with home delivery, they have many ways in which they can improve the logistics of their business to increase the operating cash flow. So there absolutely is ways that they can grow their profits. So I do think Tesco's are a great company to hold right now. And again, my rating for Tesco's is better than cash. Now, my third one, nice and simple. This is British American Tobacco. Now, British American Tobacco have amazing revenue, an amazing amount of free cash. They typically operate with a free cash flow. If you do a basic intrinsic value calculation, you just work out how much cash they make over 10 years. There's pretty much no standard system that wouldn't spit out that this is incredibly undervalued. The reason it's undervalued is just because people don't want to own a tobacco business, a business that, you know, causes cancer. And also from vaping, they've started this new market. And I really do hope governments step in to regulate this one just a bit more than they currently are doing, because I do have an unease with the way that it feels. The bubblegum flavours feel targeted at kids, and kids are certainly getting hold of this. I don't like I want more studies done to check that the way that people use them is not harmful, because I know that with a cigarette, people have one, you know, there are people that will have them chain smoke all day, but typically people will have 2 cigarettes a day or a pack a day, but people will vape all day long. The average user of a vape will do it all day long. So I hope studies go into this, but that leads me into the con with British American Tobacco, which is their new vape product could face a lot of regulation, and their cigarette products still do face regulation every now and then. In fact, there are supermarkets in America that have just taken cigarettes out of them, enormous supermarkets in America that have just taken cigarettes out of them. So, you know, there's always pressure on companies to stop dealing with tobacco companies. There's the general drive away from tobacco, but you know what, some people like the products, some people like to smoke, and I think it's their freedom to do so. I personally do not smoke, but their business is really well priced, their dividend is really good, they're showing great growth, and they don't advertise. So for me, I think they're a perfect business to hold during a recession, but you've got to make your own assumptions. Perhaps this isn't something that you want on your conscience or in your portfolio. Next up is Cineworld. So Cineworld, I'm going to start with the cons on this one. It's being sued at the minute, and it has an enormous pile of debt. The lawsuit, I think, is set to, they're on an appeal. There's no end date set for this appeal, but they expect it to finish in, I think, summer next year. And that is the issue, is that appeal, that lawsuit, if it goes through at the current price, would bankrupt Cineworld in its current situation. And the reason it would bankrupt Cineworld is because they currently have an enormous pile of debt for purchasing Regal Cinema in America, and they got 1 year of earnings while holding Regal, and then went into a COVID pandemic. And so this is the only business that's in my portfolio that truly got hit by the pandemic, and hard. And so they purchased Regal, they got 3 billion in revenue in 1 year. They got 500 million free cash flow after paying a 500 million pound dividend. And that's why the Regal shareholders got disgruntled and sued to get more money, and they settled that out of court, but Cineworld are delaying this lawsuit. Basically, a bunch of bad news has given this stock a really bad name from an investor point of view, but realistically, Cineworld are, they have a whole year to earn a lot of cash that they could use to pay off this lawsuit, but at the same time, this lawsuit likely will not succeed. And from the last annual general meeting of Cineworld, Mookie talked about this. Mookie is the CEO of Cineworld, and it really doesn't seem as they seem very confident that this lawsuit is going to go away, and that Cineplex did wrongfully practice, and they were right to cancel the deal. Either way, I don't even think that the lawsuit, if they failed the appeal, I don't think that would bankrupt them. I think by the time that they get to summer next year, Cineworld's financial situation will be completely different. But that's also a reason that Cineworld are not selling shares. They don't want to have more cash for Cineplex to sue them with. So Cineworld really want as little cash as possible. So they're going to take all the cash, and they're probably going to use it to pay off debt. So that's what we want to see, that we want them to just pay off their interest payments. As a shareholder, that's all we care about. And I think that would be great over the next 2 years. And certainly by the end of the 2 years, either they will have gone bankrupt, which I think is really unlikely, or what's more likely is you'll be getting a 500 million pound dividend every year for a stock that currently costs 300 to 400 million pounds. 400 pounds into this stock, you'll get a 500 pound dividend. So it's just remarkable. Put 4,000 pounds on it, you'll get 5,000 pound dividend and have 4,000 pounds. You could only imagine what that 4,000 pounds would be worth when that 5,000 pound dividend comes up. Likely that the dividend would be 10% the value of the share, so that would mean that that 4,000 pound would have, for that dividend to be rational, would have to be worth 40,000 pounds. So I absolutely I think there's a risk of this stock going bust, but my God, are the earnings worth it on this one? Really worth that bet, 100%. Okay, so the final one is Alibaba. And what I like about Alibaba is, first of all, their intrinsic value of their business. They're a bit like Amazon, and they are the e-commerce of China, and they seem to do a really good job out there. They make a lot of money. They're growing the amount of consumers they have. Their free cash flow is going up. They did get hit by the pandemic, but that didn't stop them growing. That's the important thing. It just hurt their cash flow. They also got fined during the pandemic, and so that also hurt their cash flow. But Chinese government have said that they're not going to fine them anymore, and they're done penalizing the business. They've got a new CEO that is more cozy with the Chinese government, which does represent another con, that Jack Ma was the person that grew this business, but at the same time, as Charlie Munger would say, invest in a business that any idiot can run, because sooner or later any idiot will be running it. And this is absolutely one of those businesses. I think any idiot can run an e-commerce business. Alibaba, the hard part would be setting up Alibaba, but that's done. The infrastructure is there, and all the new CEO needs to do is ensure that they're constantly reinvesting in making the infrastructure more automated. The more automated it is, the higher the operating income will be of the business long term. And if you watch videos online, you can see the new infrastructure that Alibaba are building, and it's really cool. And they are absolutely thinking about how customers should use this. The face recognition on these robots that deliver parcels is a really cool way of eliminating the most expensive part of the business, which is the last mile, which is not something that Amazon can as easily do as Alibaba. Alibaba have, because of that connection with the Chinese government, have much more ability to roll out innovative change. And another thing is every other Western country where has all the businesses that I really want to own are going into a phase over the next 2 years of raising interest rates, and that is going to hurt growth stocks, and that's going to hurt every single business and investment in the UK. And China are going from a high interest rate around 5% to whatever it was, now it's 3% I believe. They're lowering the interest rate. They're in a completely different situation to us. And so I actually think that Chinese businesses will be growing over the next year or so while the Western world is shrinking, especially with this the issues that's going on with Russia. For us, for China, that's working out amazingly. I have no animosity towards Chinese businesses. I certainly have a thing or two to say to the Chinese government, but the businesses in China are brilliant. And they're run by great people, and there's great workers. I work with a factory in China. I love speaking to them. They're great people, and the only issue I have is with the Chinese government, and the people that work at our factory have more than a thing or two to say about the British government, and I can't blame them for the things that they say and think about them. So I think I don't personally see any hypocrisy there. Anyway, again, that's up to you on all of these. These are my thoughts, my interpretations of these businesses. I hope you enjoyed my thoughts, and let me know what you think in the comments, in the description, in the thing, and also check out my profile where I have these positions on eToro. You can copy me, but that's up to you as well. There's no pressure on that, and I suggest you do your research into the positions that I hold and study my other videos to get an idea of how I invest. Don't just blindly follow me or blindly follow anyone. Stocks and shares can be a great way for you to invest your money, but try not to think of it as a way in which you can get rich quick, or just or not look at it at all. It's just a way to one day you will be able to stop working. You'll have a portfolio of amazing businesses, and they will continue working for you while you're sleeping, and that's the goal. Okay, hope you enjoyed this. Please do like and subscribe, it makes a big difference, and goodbye. Thank you very much.